And please bear with me. You might have to replay, you might have to watch it again. But once you learn this and you can see it, I swear you will be a master of the markets. You will know where price is going nonstop every time you look at the markets. Just watch this and learn this, and you will know. I'm telling you now. Cycle, which is going to tie everything together, and that is going to show you everything. How you know when and when not to get in, everything, I promise. So stay tuned. In today's video, we'll be going over the 4 main things that allow you to master the markets. That is supply and demand, market structure, liquidity concepts, and most importantly, time. By the end of this video, you will no longer be a beginner trader. You'll be a professional and you'll know how to master these markets and make some money. So let's get straight into it. Really quick, if you are new to the channel, welcome to the team. My name is Divine. I am a 6-figure funded trader and on my way to make my first 6 figures in profit this year. And I'm here to help you. Liquidity, market structure, supply and demand, and time are the 4 main characteristics of my trading strategy. And just 2 years ago, I was struggling my ass off trying to learn all of these things at once. And in this video, I'm going to break each one down to a science so you can master the markets, understand how to formulate a strategy, and we're going to get straight into it. And make sure you stay to the end because I'm going to map out a perfect strategy for you to duplicate and follow. That way you're not just learning these concepts, but you are implementing them into a strategy that you can go into the markets, collect data, and operate under. So let's get straight into it. All right, guys, so let's get straight into it. So we're going to go over market structure because this is the nuts and bolts of everything. This is the foundation of our trading plan, of our strategy, of understanding the market. Market structure allows us to know who's in control, how long they're going to be in control, and do we have shifts coming in the market? How far extended are we? All these amazing things that you're going to learn in this class right now. It will be a little bit longer, so man, just be patient, get you some popcorn, relax. And I'll also put timestamps in the video. That way, if you know some of this stuff already, we're going to go from beginner market structure all the way to complex, and then we're going to go supply and demand, beginner, all the way to complex. So let's get into it. Right now, as you can see on our market structure, we have 3 different types of structure. We always have bullish structure, which means bulls means buy. We have bearish market structure, which is bears means sell. And then we have our consolidative ranging equilibrium price action, which is sideways. If you hear somebody say price is ranging, price is consolidating, is sideways. That is the same thing as a range market because the market makes higher highs and higher lows. It also stays in the same range. It doesn't really trend or extend, as you can see here, in one direction. So when we talk about buying, we typically see higher highs and higher lows being printed in the market. Higher highs, higher lows, higher highs, higher lows, higher highs, right? On the opposite side of that, the contrary, we have a bearish market. You'll see lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, etc., etc. Very, very simple. And the way I always teach is if you are curious or not really understanding who's in control, or if we're bearish or bullish, if you can draw a line from the bottom of your chart to the top, then you know we are bullish. And if you could draw a line from the top of your chart to the bottom, then you know we are bearish. Very, very simple, very, very simple. And then as we talk about if we are ranging in price action, we understand like price, you can draw a line through none of it, right? It's not really, you can go both ways if you wanted to. There's no clear direction. We have a 50% of this level. Price is just in that range and it's sticking to that area, and that's just what it is. Me personally, I tend to stay away from this, but market only does one thing from consolidation and it expands. So after you see price consolidating, it's going to probably expand to the upside or to the downside, obviously, right? But this goes with, once we align all these things, you'll see how you can utilize that specifically to make mad money in the market. So very simple. So when price is consolidating, we simply remain patient and we just wait to see what's going to happen. So let's go over some quick examples of how this would look, which we have a few right now on GU. If we zoom out of here, we have a few right here. So when we are looking at price, we want to say, again, who's in control? That's the first question you always ask yourself, and that is market structure. Who's in control? And the way you determine that is we just map out our structure, right? Well, we can draw a line from the bottom to the top. We know we are bullish, but then we want to map out our highs and our lows, right? Our high and our low points like this, because a lot of people will get confusing when you see all these candlesticks. But at the end of the day, it's very simple to know who's in control and what your market structure looks like. And then if we've seen a bearish action of market structure, we would see something in this case, right? Where if we look at our price, we can tell from the top of our chart to the bottom of our chart, very simple. We are bearish, right? We are selling right now. There's a reason that price is going down. Buyers are not in the market. They're being taken away, disrespected, and price is actually sticking to the sell side. And if we go back up here, as you can see, the way you know also is we always take out highs when we are bullish. As you can see, all these highs are going. And then when we are bearish, we're taking out all the lows. Very simple, right? And then when we are consolidating, we're taking out highs and we're taking out lows. As you can see, we're taking out highs and we're taking out lows. It's no clear indicator of who's in control. A lot of people get very confused when they see market shifts in the market. So how do you know when the shift from bullish to bearish or bearish to bullish is going to happen? And I'm going to draw that out now, where, for example, we are pushing up bullish and then we start to get price action like this. We break a low and then we come here and then boom. So now what we get here is a shift. And the first indication that price is going to reverse or shift potentially, it doesn't mean it's going to shift or completely fully reverse. But what it does tell us is, hey, for right now, price is going to shift. And if you, I'm telling you now, just be patient, watch the video because we're going to go over liquidity cycle, which is going to tie everything together. And that is going to show you everything, how you know when and when not to get in, everything, I promise. So stay tuned, right? But essentially, when we get this first break of structure, break of demand, whatever it is, you haven't learned demand yet, but I'll show you that. Once you get that first break, and then we get another break, as you see here, we get a break, we make a lower low in the market, then you can say, hey, listen, I know we were bullish, but we may be shifting to a bearish trend, and that's what you get. And then the same thing on the bearish side is when you get a lower high, which is this, you expect us to make a lower low if you are going to be bearish. But in this case, you can't make a lower low, or you do make a lower low, but then it immediately takes the lower high, which makes a higher high. And then we start to see that trend potentially shift up, and then we start making our way back to the upside. So this is market structure in the whole, and we're going to go to the daily so we can go over a few examples of that right now. We are bearish, right? So if we were looking at this point here, we know that, yeah, price is sideways here, as you know, but we are bearish and we're moving to that downside. As you know, when we're moving to that downside, well, how do we know? Again, I'm not trying to teach you how to predict reversals, but you also want to understand where you are in the market and where the market potentially wants to go over a longer period of time. So when you are bearish, we got a lower high, lower low, lower high, lower low, lower high, makes a lower low. Then we make a lower high, and then it can't make a lower low, and then we make a higher high, right? So this is your shift. So we essentially came over here. We came over here. We made a lower low in the market. And then we took out this high, which was our point, because this is our range, high to low, right? But when we can't actually make a lower low from this point, then that shows, hey, sellers might not be in control. And then as you can see, we take that high out, and then we start to go the opposite way as a higher high, higher low, higher high, higher low, higher high, higher low, higher high. We tap into something here, and then we actually reverse and go back the opposite way. Why? Because this is a supply zone, something you'll learn later. So when we actually look at this action, and we want to know, hey, when are we reversing what structure? It's simple. Well, this is our high, this is our true low. This is our extreme point in this market. We know this is like the highest of the highs right now. We may make a shift in the market like this, and then we may try to go back out this way and go, you know what I mean, to the upside. We just want to understand, hey, where are we at? We are bullish right now, so I can take buys confidently, understanding that price is bullish in the moment. You know what I mean? So when we every time when it comes to market structure, there's only one thing that you need to ask yourself: who's in control right now? So if we were looking at this price action, I'm going to go over this really quick. If we were looking at this price action right here, let me know in the comments right now who is in control. Right quick. Make sure you hit the like button while you're at it. But who's in control at these in this market right here? Who's in control? Buyers or sellers? Are we bullish or are we bearish up until this point? Cool. Now, if we go look at some more price action, in this point of the market right here, I'm going to zoom in. Who is in control in this action right here? Buyers, sellers, or are we consolidating? Buyers, sellers, or are we consolidating? So if you were to be in the market at these points, would you say price is bullish, bearish, or consolidate? Let me know down in the comments right now. Because it's going to help you. This is how you're going to collect data. This is going to help you in the long run, because when you look at the charts, you want to say who's in control right now. All right. If we go to the most recent price action on GU, who's in control right now? Obviously, bulls. Why? Because if we take our line from bottom to top, they are in control. Cool. All right. So now we're going to go over complex structure, and then I'm going to tie structure all together, and we're going to go over the supply and demand. So complex structure is why a lot of people end up losing trades and don't understand where they are in the market, because you need to align time frames. So if we have a daily and a 1 hour, right? We have a daily level that looks like this, right? And please bear with me. You might have to replay, you might have to watch it again. But once you learn this and you can see it, I swear you will be a master of the markets. You will know where price is going nonstop every time you look at the markets. Just watch this and learn this, and you will know. I'm telling you now. So we have our daily level. So we're gonna make this level red. Daily is red. Now, our 1 hour, which I usually align with this is how we're going to map out our trading plan. So bear with me. Our 1 hour is going to be another color. Okay. All right, guys. So now we have our complex structure, and we're about to break this down really quick, and then we're gonna go to a live example because I want to get through this. I don't want to have y'all sitting here on the charts all day, but this is important. It's gonna help you out. All right. So our red line is our daily line. So if I asked you what are we, who's in control on the daily, our red line, you would say bulls, right? Because we are trending to the upside. We are respecting lows and taking highs. Very simple. Bulls are in control. But on the 1 hour, we may actually be in this area of the market on the 1 hour, right? So this blue line is what's important right now. So on the 1 hour, bulls may be in control on the daily, but on the 1 hour, bears might be in control. So what a lot of people make mistake is they take sells, and they think price is going to the floor. No, that's not right, because we are trending. So our expectation is, hey, we may be selling off on the 1 hour right now, but we're only going to sell off to probably the 50% of this level, which is something I'm going to teach you with supply and demand. But if we take this point here to our high point, right? The 50% of this level is then if you want to buy a used car or a new car, you don't want to buy it at a premium price. You want to buy it in a discount. And if you want to sell that used car or whatever it is, you want to sell it at a premium. So if you want to sell the market, you sell above the 50%. If you want to buy the market, you buy it below the 50%. So when we're selling on the 1 hour and we're bullish on the daily, we say, hey, listen, we can really only sell to the 50% because bulls are in control. So by the time we get to that 50%, banks, hedge funds, whoever are looking to get in the market around that time. They are looking to start showing and building up liquidity to make they move to the upside to continue the trend. So just because we are trending to the downside on the 1 hour at the moment, bearish, that doesn't mean we are fully bearish. So you have to be aware of that. A lot of people get so tied into the structure, they don't remember. So you always, the best way to do it is if you're looking for a trade on GU, you want to say, hey, I'm going to wait for price to come over here, tap into something to my left, wait for that market shift that we talked about. Remember, you want to see that we're trending down, lower low, lower high, lower low, lower high, or lower high, lower low. Then we make that shift. We make a higher high, lower, higher low, and then a higher high. We know we are shifting bullish, and we can start to move in accordance with the full structure point. But a lot of people will take these sells and then they try to take them to the floor, and then it gets swept at these levels down here because we are looking to buy the market back up now. Now, it's the same exact thing when if you were bearish, which I'm not going to draw it out, but if you were bearish, I can actually flip it. So if we were bearish, again, it's the same exact thing. Well, we are bearish, and this is the leg we're looking at. Well, people say on the daily we're bearish. The 1 hour we were bullish in these points, and then people are like, oh, I'm just going to keep buying the market because the market is showing me buy signals. Well, when we make that shift on the 1 hour, that market structure shift, then it starts to go back bearish, aligned with the daily. Don't you think if the banks use the daily to move the market, and the daily is the primary source of which way we're going, that is the larger scale of where the market is headed, which is bearish, Once that 1 hour aligns, don't you think those moves will be a lot stronger to that downside? That's how you want to move. So understand, hey, you can buy the market up once you see the shift in that counter trend, but you can only buy again to that 50%. Once we get into premium, they want to sell in the premium, which is up here in these levels. And once we get up here, that higher low, that lower low we make, that lower high, and then we make a lower low. That's what we're intending. So you get a longer trade, a more profitable trade, a more high probability trade by following the trend on the higher time frame aligned with the lower time frame. So let's go look at that in real time and what that would look like. We have a low, we have our high point. Let's map this out. We have our high point and we have our low point, right, that we made. Well, if we're bearish, we expect price to do what? Lower low, lower high, lower low, lower high, lower low, right? Okay, cool. If we all can agree that that's what price should do, then that's what price is going to do. But what tells us that? Well, again, on the 1 hour, if we looked at this, the 1 hour will be showing us buy signals. Buy signals. We need to know, and this is about to get us into supply and demand. We need to know, hey, the 50% of my level, this is my high, this is my low, right? Anything above this level here to 50%, I'm not interested in because I know that sellers are in control. So based on my market structure, hey, sellers are in control, but I'm going to relax until we're down here. We just had a shift in the market. So on the daily, we had a shift, and on the 1 hour, we had a shift. So now we are playing the counter trend buys on the way up. But once we get above that 50%, the market could turn around and make that lower low any time of the day. So a lot of people will be selling from these areas, and this is why you see price halt and then goes to make a new low eventually, and we get that lower low in the market, right? As you can see, very, very simple, very, very detailed, not super detailed, but that is how it works. If we go a little bit more recent over here, same exact thing. The market showed, let's see, the market was bearish. We made a lower low, made a lower high, right? Which we just traded from. But the market stopped here and then made a higher high in the market. So a lot of people may say, hey, man, we're bullish. Well, again, where's the high and where's the low? This is our high and this is our low. The discount of this level, we take our points from high to low. The 50% is here. So now once price was below and it brought up because it was in a discount, but now price is in the premium and they may still look to make that lower low that we anticipated happening, which ended up happening. But because people see this big buy signal in the market, quote unquote, understand that that is liquidity is something we'll talk about later, and it's unimportant. It's not important for our trade right now. What's important is that we actually stick to understanding, hey, suppliers are still in control. We want to understand that we want to sell from a premium level, and then we're expecting that lower low. And we know that even though this buy signal showed, it is still counter trend to what we overall know. It's just lower time frame action. Once we realign with the higher time frame by getting to higher time frame levels, then the price realigns and continues that move to the downside. Always remember, hey, who's in control? Where's my daily bias? Is the daily bearish or bullish? Then on the 1 hour, you want to say, hey, like for example, really quick, I'll show you this one last example for our market structure, for our complex market structure. We are bearish, right? Higher, lower high, lower low, lower high, lower low. Well, let's go look at this action in here. Well, what this action looked like on this lower time frame, even though the daily was bearish, people were like, hey, we're buying now. Well, as you can see, when you play counter trend, those buys, we don't know where price is going to stop. We can map out levels to determine or see where it's going to stop. But as you can see here, price started going bullish and then went bearish and then went bullish again. And then eventually we made that market shift, that true market shift, because we got to a point that we liked over here. And then we started falling and we end up making our lower low. And as you can see, trending lower high, lower low, lower high, lower low, lower high, lower low, lower high. And we made a lower low. Very, very simple. So understand, hey, price may show you on the daily that we are, buying up the market or something like that, but understand that it just tagged into this supply range here and continue the trend to the downside. So now let's talk about supply and demand and how we can align market structure with supply and demand and tie those two things together. Okay, so let's look at a couple examples from our buy side. And as you can see, when we're talking about ranges, these ranges don't always have to be like super beautiful, right? They don't have to be like laid out right next to the price. It can look something like this and then make that move. So when we're looking at this, we want to say, hey, we're having a range of price action. It's pretty sideways. Go below, gather those orders, just like we talked about here. We go below, gather those orders, and then we have a big move to the upside and a strong move to the upside. This is now a level of demand. And how we would draw this out is usually I can take the whole range of the area because it's on a daily. We don't have to be as precise. We just want a point of interest. So when you actually map out these supply and demand zones, you're going to consider them a point of interest, and that's it. You're not now, if you're a swing trader, you can trade from these levels directly, but if you're somebody who trade or day trade, you just wait for price to get to these levels. As you know what our structure is, so we can sell to that level, and then we're looking to buy from the daily. Then when price get there on the daily, we can go from there. So we get that big move and then we map it out. Now you would say, hey, well, Divine, don't we have demand zones here? Well, yeah, consolidation, we push down. This is a demand zone here. This is a demand zone here that we didn't come to. This is one here that we actually tagged, and this will be one. Well, the further up from this low that we get, those demand zones get a lot weaker and weaker and weaker. So you have to understand, like, remember we talked about our market structure. Once we get that shift, we expect price to sell sorry, we expect price to sell into the 50%. So roughly into the middle of this level. And then we'll look. But once we map out our demand level, we can say, hey, we may take buys here and take a loss. That's fine. We may take buys to expect a higher high. We don't make that higher high. So we may take a loss, but now we know that we can sell all the way to our demand zone. Very, very simple. So this demand zone is how you would draw this. It just take our range roughly where it's around, and then you just map it out. It's a point of interest. You don't have to be super precise. It is a point of interest. I will show you how to draw them precisely on the 1 hour and everything. Now, over here, we have something similar where we have a level that pivot. We talked about our pivot demand and supply. So we want to make a small move and then a sharp move. Very simple. So here we make a very small move to the upside, sharp move to the downside, and then we shoot to the upside. That is our level of demand. And the way you want to map this out is you want to see, okay, we have wicks in here. What I usually do is take this candle's open to low. If this candle's body is like stronger or is nothing tagging it, which I'll show you, then you can take this candle only. But here, just take the candle that started the big move, drag it over. And this is simply how we would be able to enter the market because one, we know market structure wise on the daily, we are expecting higher highs. And also we understand that we just made a level of demand in the market on the daily, which is a lot stronger than a 1 hour. So keep that in mind. So any demand that you map out on the daily is going to be a lot stronger than lower time frames. The higher the time frame is stronger. And we expect price to make a move to the upside, maybe to the 50%, because we don't know if we're going to sell off later or not. So the 50% of this level somewhere around here, and then we get out the market. It is very much that simple. And that's just simply aligning market structure with that supply and demand zone. So that's a beautiful demand zone. Also, these are demand zones right here, like these ones here, where we have a nice candle here. Well, what happened? Well, we can map out, this was our first level of demand, our second level of demand somewhere in here, because again, if we zoom in, this candle here was the last down candle, and then we created that big move to the upside. So we drag that candle over. We can either just pull it down to that candle. I usually take the two candles that created the move because it helps me be more precise, and it'll help you too. So keep that in mind. 1, 2, and then big move. And then we come back to that level. You can take an entry here. And then also, again, the last big candle before the down move and then the up move, you can take this entire candle. We can drag it over and we wait for price to come back to that level. And then we come there, we tag it, and we go beautifully. So on the buy side, as you can see, we have, again, it's just simple. These demand zones like this, right? Because we gather orders and then a sharp move to the upside. Very, very nice. The most important thing that it did here was take this low right here, which we call a sweep of liquidity. We take this low, and then it shows some displacement in the market, a lot of imbalance, a lot of movement to the upside. And then as you can see, once we come back to that level, like we talked about, we want to join the ride with them, and we get in and price flies away. As you can see here, we have supply in the market. Well, what we got here was price came down, and you see that we had a big move to the upside, then a sharp move to the downside. Very sharp, big candles. That's what we want to see. If we map out, in this case, because you have a large wick up here, you will take this last candle before this move, and you will map it out as our supply zone. We drag it over. And then you see that price held this previous demand zone. So we were actually in between these two zones, and this was the low and this was the high. So we couldn't really sell here at the moment. But the reason this is our demand zone is because again, one candle, one pivot down, and then a pivot to the upside, and then the same thing here, pivot to the upside, pivot to the downside. Is not a true supply because it couldn't take these lows, but we can map it out. As you can see, price wick that level, above, and then it made a low, made another low, and we got that true market shift that we talked about before with market structure. So if we looked here, we'll say, hey, who's in control? Well, sellers are in control because we just took out the low that made this new high, right? Simple. So now when we're looking for sales, we're just looking for strong levels in the market like this one that created a low and then created an even lower low. So we could say we want to draw this level out and drag it to the left and go from there. For example, like this one, beautiful. It did what? Took some highs first and then made a new low, taking out all these lows. So when we look for our next level, we want to say, drag this up here, and we want to drag it to the left. And that's our supply zone. And the importance of this supply zone is, as you can see, we drag this instead of using this candle, which we could have, we use this. And the reason we use this is because in between here, there is a gap in the market, which shows strength. Similar to this one, right? Shows strength. The orders were entered here, and we like to incorporate that because sometimes price come to this imbalance. If you know about imbalances, if you don't, I'll talk about it another day because I utilize them, but they are not that important to me. I just see them all over the market. But we see price coming to this level of supply that was created, which also swept highs, which is way more important. We don't want to just take levels that push down, right? Like this one. This level didn't sweep anything to the left. So that level ended up getting swept as liquidity, but we come back up here. And then as you can see, utilizing these levels, price falls very, very far. And another example here is we have this push up, push down. We took a low. This is a valid level now, and you have a beautiful up candle and then the beautiful down candle, which took the lows. You can take that green candle, drag it to the high or to these highs. I always protect all the highs, drag it over, and then you can simply take a trade from there if you would like to and look for a price to move and create that lower low like so, right? And then when we talk about liquidity, we'll understand and break down why we could actually target way down here and potentially get in a trade like that, especially for swing traders and people like that. So that is how you would draw out supply and demands. And the importance of supply and demand is very simple. Now, also being able to see supply chains is very important. So something like this, where you have a chain of supply, take the trades. Don't be scared. Take the trades. Take them, take them, take them because they are very important and they allow you to see what's going on in the market and how it's happening, how supply is actually formulating. And then eventually you start to get these big moves like this. And all it says is consolidation of the banks building orders, like we talked about in the previous market structure breakdown. And once you see that consolidation, we know price can only expand. And if you believe price is going to sell off, then you know that expansion will be strong out of that consolidation. So if it is allowing you to get orders, get entries, get in the market, be patient, and let price show you what it wants to do. So the last thing with supply and demand that I want to talk about really, really quick is extreme levels of supply and then extreme levels of demand. As we mentioned in this example here, we have a low and we have a high, right? Well, most people want to get in the market up here because they know demand is in control. So they're like, hey, you can take this entry because we haven't taken out any lows. We're respecting. You can look at these levels right here. You can look at these levels down here. Well, which one do you take and how do you know which demand to take? Well, we talked about premium and discount. And what price is doing is pushing, making a new high, higher low, higher high. And then we would expect price to come into these areas somewhere around here. I'll just take this entire range of demand and create a higher high. But then it doesn't. It doesn't do that. So now we want to look at our range and say from our high point to our low point, where are we in the market and where's our 50%? So from this high to this low, 50% is here. So anything below that we want to buy. But a lot of people map out like demands like this and they try to buy here and all this stuff like that. Price at that point it's not enough orders in the market for price to come here, stop, and then fly away. We need a bunch of orders. The algorithm's job is to gather orders and do it efficiently and then effectively. So these levels like this one here is very beautiful, right? That is a beautiful level. This is not a good level because it's above the 50%. Remember what we said. We want to buy in a discount and we want to sell in a premium. So if I was looking to sell, once this break happened, once this break happened, because it is counter trend, if I'm looking to sell, where would I want to sell from? Well, we go again from our high point here to our low point down here. Our 50% is here. Anything up here, I can sell from. So if I say, hey, this is a nice supply level, or we broke from here. All right, cool. Well, as you can see, this will be a nice supply level right here. But what happened? Price didn't come back to that level immediately. Price didn't break the low and then come back, take the sell, take it here. Price just went straight down to demand. So that once we get to the extreme level under 50%, that supply level is no longer valid because liquidity, right? And now when we look at this high's job is to take out this low. If it can't do that, then the high gets taken. So the highs, it gets taken. Very, very simple. Very, very simple. So if we say, hey, listen, price is bearish right here. Remember we talked about complex structure where we got a supply zone here, supply zone here. These supply zones that we have here, we can't trade off until it shows bearishness, which this was the last low. So this is where it showed bearishness. Well, anything after that, it didn't actually come back up here and try to get into more sales. It just went straight for the buy demand level. So we just look to buy from there, understanding that this level is going to take out all of this actual information in here because this information is no longer valid. Okay. Now, on the opposite side of that, on the sell side of that, our high right here and our low. Well, price did what? Took a low, and then we come in here, we end up taking highs right here. We take highs. So this level took a high. You could take that trade, very risky, but you'll be counter trend. You can say, hey, listen, we showed the market shift. I'm going to buy to the 50% of this high to this low right here, right? Once we get to the 50% of that level, price could have did this and then came back. We could have bought again, and then we could have bought into the premium, but it didn't do that. It went straight for the premium, right? So once we get into the premium, we understand that these demand zones that we have mapped out or whatever, like this one, these are no longer valid levels. But these supply zones over here as well aren't valid right here because they are at the very middle of this area. This is like from this high to this low is around a 50% level. Well, it may be something at the extreme level, which is always the best level to trade from, that price may want to go up here. Because again, remember what I said for the buy example. We're not going to just stop in the middle and make a new high or a new low and blast off because there's not enough orders. So these levels may be valid and nice, but they don't have enough orders for the market to make this kind of move, but this level did. You understand what I'm saying? So that is supply and demand. Understand that is very simple. So when you actually going and looking for these levels, you want to look for three things in these supply and demand zones. You want to look for price taking highs or lows first, and you want to look for price breaking a previous demand or supply level. Once we break that, we map it out, we incorporate our imbalance in the map out, we drag it over, we enter. Very, very simple on how we doing it. And for the buy examples, the same exact thing. We want to look for a level that sweeps liquidity, so takes lows, like this one here. We want to look for a level that sweeps liquidity, takes highs, and then we can potentially come back here or not, like this one, come back here and then take a trade from there. And on the 1 hour, you can see it beautifully where we got levels that sweep lows, take highs. We map out this, remember the two candles, you map out this level here of demand. We take an entry here, and then we go to make a new high, targeting some liquidity. Another example, again, We have this level here that swept Asia highs, liquidity. We broke demand right here. And then we map out these levels in here. It actually tapped into something here, but we do have a nice imbalance here that price probably wanted to come into. We dragged that over. Probably would have missed you, but at the end of the day, this is our supply level here. And we just wait for price to come back into that. But price did end up coming back into that. It swept that level, came to the extreme, and then made its newer low. So that is how you trade supply and demand. I don't want to make it long-winded, but that is the breakdown of supply and demand. Let me know in the comments if you traded like that. Have you heard anybody teach it like that? Let me know what you think about that. And we are going to get into liquidity and map everything out on the liquidity side. All right, guys, so we're going to go over liquidity, and this is the last segment. We will be breaking down every single thing and putting it into one little strategy by the end of this. I'm going to show you a few examples, so bear with me because I know it's a long video, but this is going to help you be a master of the markets. It's going to help you make money in these markets and understand what's going on, and the only thing you got to tackle after that is just a mentality, which we're going to be talking a lot more about in the future videos. But we have a few examples of liquidity. One of my favorites, retail, internal, external range liquidity, weak highs, weak lows in Asia session. When it comes to supply and demand, I'm a supply and demand trader. You know what I'm saying? So we not liquidity. At the end of the day, it can happen, but our job is to prevent it from happening. And that's what I'm going to show you. So retail, double tops, double bottoms, triple tops, triple bottoms. I talked in the video breaking this down more in depth. So go watch that if you haven't already. But internal external range is by far the best one on how to make and take the biggest trades of your life and understand where targets and everything can take you. Weak highs and weak lows is very good for targets, and also just understanding what to trade off of and what not to trade off of. And an Asia session is very good for targets, very good for understanding where price wants to go and who's going to get swept and levels that we may attack throughout the session. Let's go over weak highs and weak lows really quick. Let's go to the 4 hour and break this down because it's beautiful. So weak highs and weak lows. The smoothest example, when we say structure, we say higher highs and higher lows, right? Well, the reason why we get higher highs and higher lows is because this high right here is a weak high. This high here is a weak high. This is a strong low. This is a strong low. The reason being, these are strong because they did what? They took out a high. They took out a high. These are strong and protected levels of demand or lows, right? Well, these levels are weak because they couldn't do what? Take out these lows down here. So a high's job is to take out a low like so, right? So we were talking, its job will be to do that. And a high's job in a low's job is to take out a high. So the fact that this high could not take out this low, it is now liquidity and you can target it. It is a low-hanging fruit target. So when people talk about, I told you I was going to teach you how to enter the market. I'm going to teach you how to exit the market. You know what I'm saying? Listen, if you see a high that cannot take out a low right here, if you see a high, right, that cannot take out a low, it becomes liquidity. This is this example right here, right? So we have price push up and do what? Take out this high. That is now a protected level, a protected low. Well, what can we do in that case because that is a protected level? We can look for what? Supply and demand. Man, let me know if y'all getting this in the comments, man. Let me know if y'all getting this. Let me know right now if this making sense. All right. So we are now a protected level because we took out the high, and this high stepped in the market, brought in supply. We got supply creeping now. Let's map out our extreme demand zone. Well, it's probably this one right here. There was no other demand zone in here that we would have liked. If we, based on our teaching, we wouldn't have liked this. We wouldn't have liked that one, and we wouldn't have liked this one because it's at the 50% right here, right? Exactly. So we wouldn't like that level. But anything below it, which is only this one, we would love, right? This is simple. You can take this trade right here, stops here because this is a protected level, and target minimal this high on the 4 hour. So it's a swing trade. But knowing that this is a weak point in the market because this high did not do its job in taking out this low, it is weak. Even though it took out this and this and this, those are unimportant when we realign our structure points and we realign to the daily or the 4 hour level. So when we realign, price came down here, respected, and took it out. Now, let's say that another example of how we would know, hey, price is gonna transition. Well, we made a low and then we took out a high. Showed that shift. Remember our market structure. So when we say who's in control, well, bulls are in control. Okay. Where's our liquidity? Well, this high didn't do its job. That is liquidity. And then also we talked about double tops. Well, we got double top liquidity there. We got double top liquidity there. Okay, now we have liquidity in the market. Well, we got a shift. Okay, bulls took back control. Okay, demand level, we have a demand level here. No true supply level because it's a weak high. So that supply level don't matter because we reached the extreme levels. So now we say, well, how would you know you could target this? You know because you have liquidity. You have reason for price to go up here. You don't got to target this high. You could target low hanging fruit right there. You could target this low hanging fruit. Why do you think price flew through all of that so smoothly? Because it's liquidity. They needed to get in all these sellers, stack all these consolidated orders, range in price action, get all these sellers in, make people believe price is going down here, and then pop and go. Very, very simple. So that is a weak high and examples of that. Another example of like a weak low. So we have our high point, and this high is strong. This high did beautifully by sweeping liquidity, right? It did beautiful by sweeping liquidity. And then it did what? Took out this low. That is a strong high. That should be a protector high. Well, we have this level of supply already tabbed, and then we have this level of supply kind of tagged already. So we have two levels of true supply. We come in there, come into it. We can target, we can target this low, knowing that this low did not do its job in taking out this high. It respected that high, so we take out the low. Very, very simple. Where's my liquidity? Also, we have relative equal, like a triple bottom down here, liquidity to target. Weak low, triple or double bottom right here. As you can see, a double bottom, triple bottom with all these points. It's just orders in the market. Pair liquidity in the market. Pair liquidity to target. Now let's talk about internal and external range liquidity as well. So when we talk about internal and external range liquidity, let's say, for example, we have this same price action right here. And we say like, okay, well, internal range liquidity and external range is very, very simple. And this is our internal, right? So everything inside of this action here, let's go here. Everything inside of this triangle, right? Everything inside of that is our internal range liquidity. So that means these lows, low, 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 is internal range liquidity. Our external range liquidity will be the external high and the external low. Well, let's just say that we were bearish already, and let's just say price was coming up to tap into the supply zone, and all we had to do was wait for that market shift right here. Wait for this market shift, and then we could say, hey, price is going to fill all of this liquidity internally. Remember what we said, hey, we only really map out the extreme level of demand down here. Same way we mapped out the extreme level of supply. So that means when price showed this shift right here and took out these highs, we already assumed that once that first break happened, we were coming up to the extreme supply. Whether we respect that supply or break that supply, right? Like this, it doesn't matter. But we were expecting price to come up there and work there. Same thing when price takes this first low, we expect price to go to that extreme level of demand and test it out, and either it breaks it and continues down, or it respects it and continues the opposite way. It's very, very simple. So an example of that is here. So our extreme points in these markets is this is our high and this is our low down here. We made a market shift, and I'm gonna stay zoomed out because it's very simple to see. We made a market shift here. We took the highs. From that point on, right there, we say, hey, listen, I don't know for sure, but I'm expecting price to continue high. Then we make a new high. The first thing I'm going to say is we need to map out supply levels that are up here to see where price wants to go, because these will be important. Everything else, let's look for our liquidity. Well, we got equal highs roughly right here. We have some trend line liquidity inside of here. We have these like equal highs up here. That's like trend line liquidity, right? And we expect price to come all the way to these points and then make the big move down to the downside. Let's see. Boom. So this one invalid. Exactly. So again, this is our internal range liquidity. Price made that shift and made its way all the way up here. So if you were a swing trader, you could have been in the market somewhere down here and said, I'm just chilling. I'm just waiting for price to get to this level here, and then I'll relax. And we eventually get to that level. Beautifully, we get to that level. And then we end up reacting from that level and then breaking that level. And also, once we got to that level, you could have said again, like, hey, we got the first shift. I'm looking to sell. I'm looking to sell. Let's say we got a sell here. I'm going to sell to the liquidity, or I'm going to sell to the 50% like we talked about before. So this is how you can utilize internal and external range liquidity, because if you just look at the market, it is nothing but triangles, right? It is nothing but triangles. As you can see here, triangle filled that internal range, respected it, a demand level, went and took the high, came back right here in this area, respected it, couldn't make a high, tested this little mini triangle right here, as you can see, and then we created a new high. Internal, external range liquidity, just like if we zoomed all the way out on the daily, this high, it's crazy. This high and this low, we had the market shift, we making our way all the way up here to test out these levels here, right? We have our liquidity, and then we have equal highs in here, all types of stuff. Liquidity here is a ton. So that is our internal, external range liquidity. This is how 2 years ago I knew that GU was going to make its way all the way up there. Very, 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 very simple. Okay. And then the last thing is our Asia session liquidity. So Asia session price looks to take the highs and then takes the lows. Or we take Asia session highs, lows, and we play around. But essentially how I use Asia session, let's go to NAS 100. How I use Asia session is very, very, very simple. So when we are talking Asia session liquidity, I use it in a lot of ways. And one way is I use it for confirmations and stuff. So for example, we had a sweep here. This level broke level, so I know that this was a valid supply level. We mapped that out, and then we map out our next supply level. Well, as you can see, our little blue box on here is our Asian session, which is liquidity. The market started down here, 7 o'clock Eastern Standard Time, New York. Well, when price comes to this level, I know that it's sweeping the highs of Asia, tapping into supply. Who's in control? Sellers. I can take my sell right here and put my stops above here and then target whatever 1 or 2, 1 or 3, whatever it is that I like. Very simple trade. That is how we use Asia. Other ways that we use Asia is, again, we just say, hey, we swept the lows. We took the lows of Asia. We know that bulls are in control. We just want to see some intention. So we sweep the liquidity of the lows. We use Asia as liquidity. We actually ended up taking that liquidity, rejecting back to this level. We could take an entry here. And then because these highs couldn't take out this low, we know that as weak high, weak low liquidity, and we could target something to the upside in those regards. Same thing exactly here. We sweep the lows, we take the highs of Asia. We know that liquidity was built up. This trade actually here I took from here. Remember it was a demand level that I wanted. I knew that price had took Asia highs, so I wanted to see price take Asia lows. No, actually, price was consolidating, came to this level, and Asia highs were still available, meaning we still have liquidity to target. And how did I know price was coming down there? Because I looked on the 15-minute and it was very clear. Jesus, how far down do you want to be? And then we could simply put our stops below here and target Asia highs or look to make a new high in the market, whatever you like. Very, very simple trade. Very, very smooth process in the trade and use Asia highs for that. And then also you can use Asia highs for future targets. For example, like this Asia high we left here, unmitigated, untouched. So if we said this was our demand zone somewhere over here, we could look to buy here potentially, and then we could look to target these Asia highs for the future. And as you can see, price actually gapped up and respected and then flew away, et cetera, et cetera. So we use Asia session very often. It is a huge part of my strategy and how I operate in the markets and use liquidity to smack the markets. So now let's go over one example of a trade and then I'll let you guys go. All right, guys. So we are going over the one example, and this is going to tie everything together and show you how I actually break down top-down analysis all the way to a trade and then to take longer lasting trades as well. So on the daily, as we look at NAS 100, we know that we had a level that swept liquidity here. We have a level that of demand in these areas down here to the low, high to low. That was the last point of demand or so. And we mapped that out. We also know that up here was a level of supply, and this supply gave us a reaction, as you can see in these areas. So it's not necessarily a supply chain, but it was something that the market gave us and showed us was important. And then down here, we have these little wicks here, which shows a level of demand. It was a range, and then we have this big abrupt move to the upside. So we know that this is also a level of demand in the market. We probably could refine that down here. And I want to show you how I actually got in some trades utilizing this exact action and just reacting to the market, responding to what it's showing me. So I know that before I seen all of this, I was looking for price to move to the upside, but never 100%. It's just my bias and what I'm looking at, but I respond to what the chart show me. So based on everything, this is what I see, and I'm saying, okay, let's go to the 1 hour and see to these points what we got. Well, this beautiful sell that I took here right here that I showed you guys in the last example was because I seen a level of supply here. And the reason this will be a level of supply is because to the left of it, which is a lot more complex for you, but to the left of it, we had a level of demand. Price, wick, wick, wick. And then we seen an influx of orders get pushed in the market, showing that was another level of supply. But this level could easily have just made this a lower high and then a lower low, blah, blah, blah. But it was so strong, people stepped in the market there. So we actually tagged that level. I tried to take sales here, it didn't work out. It just played around, small win. But then we actually swept that level in the next sessions. And once we swept that level, we ended up taking lows overnight, which was down here. As you can see, all those lows was taken. So now I'm saying, hey, who's in control? Again, why do I want to take this trade? Who's in control? And where are we headed? Well, we know on the daily, we are headed into this daily level that we have mapped out. And we also know that right now supply is in control. So I want to see if I can catch orders or sales to that level and then get out the market and relax. So we have a supply zone here, and we drag that over. And then we also have a supply zone here. Now we say, why would I take this trade? Why is this trade important? Well, we want to map out our supply chain. We know that we have a supply chain forming here. We also know that we had a sweep of liquidity here, which is very important when we map out our supply zones. We want to see price sweep something and then make that abrupt move to the downside and break lows. And then we also want to align our supply chain. And then our structure, we know supply is in control or sellers are in control. And then as far as our liquidity, we know we have a demand zone to get to, right? We know that it's a lot of orders down here. The market wants to get to this liquidity in the market and they want to do it as fast as possible. And also we have Asia session here, highs that we can use to get buyers in, thinking we're going to break out, and we actually get them in, and then we can propel our trade to the downside. And that's how we would take sells here, put our stops here, and then just target simple trade, just target that area and keep it very, very simple right there. So that is how you are going to use all of these things in one whole. You got market structure, supply and demand, liquidity, and aligning all of it together with time frame analysis and breaking everything down. This is how you're going to do it, and this is how you keep it very, very simple. Let me know in the comments what you got out of this video. All right, guys, so before I forget, we want to talk about a trading plan and the importance of having one. The trading plan allows you to formulate everything before you actually get in the markets every single morning, and it's very good because you have something to stick to that is proven. Now, what I would intend or say you should do is the first question you ask yourself when we talking about market structure, who's in control on the daily and the 1 hour? So if the bulls are in control on the daily and the bulls are in control on the 1 hour, we are looking for buys. If the bulls are in control on the daily, but the 1 hour is currently bearish, you have two options. You either sit out, which I would say just relax and wait, or you can say if we're in the extreme point of the premium of that level, you can say I'm going to sell to the discount and then wait for buyers to take control and show their intention. So who's in control on the daily and the 1 hour? Well, the next level of our trading plan is where are my key supply and demand zones for the day? So before you even start the day, go on your daily, map out all those key levels, even if they already been tapped into, map out those key supply and demand levels and do the same on a 1 hour. Look for a supply or demand chain that'll help you propel price up or down and move in the right direction. And then the most important, as you all know, is liquidity. Where's my liquidity rested in the market? Why will the price move to this area or move to this area? Is there liquidity for price to go gather? And does that align with my trade? So is there double tops, triple bottoms? Is there trend line liquidity? Is there an Asian range, high or low sitting in that point? Stuff like that. There are a lot more forms of liquidity, but those are the main ones. Also, did we just have a market shift? Are we going to fill in the internal or external range liquidity, take a high or low, whatever it is? And then the most important part out of everything is you can have all these things aligned, but your time is the most important. So New York session, 7 to 7:30 to 11 a.m. Central Standard is my session. For New Yorkers, 8 a.m. or 7:30 a.m. to Eastern time, all the way to 11 a.m. is a key time. That is the best window for you to trade. It will have the most volume, the most market makers in there to help you propel your trade and actually take the highest quality trades. So that is a simple, smooth trading plan. If you want a more in-depth trading plan, let me know down in the comments right now. I'll get something out to each individual, or I'll just make a high quality video, or I'll do a live or something. So in the comments, just type the word trade plan, and then we'll figure something out with that. But let's get it.